University of Vera for giving us the opportunity to be here today. So I'm going to give an overview on the Italian legal framework in tax consolidation regimes. So we will talk especially about the domestic and worldwide consolidation regimes, and we will say something about VAT group and VAT group liquidations. So first of all, we have to start with an historical review, because before 2003, Italy didn't have any specific regime for group taxation. We had only specific rules which had an indirect impact on groups of companies, but there were no general rules for group taxation. So only in 2003, the Italian legislature introduced two alternative optional regimes, which are the tax transparency regime and the tax consolidation regime. These regimes are optional, so this means that companies are not obliged to opt for this regime. In some cases, it could be better for the companies to keep the ordinary regime, although usually companies benefit from the option for one of these regimes. So after 2003, of course, we can say anyway that the Italian group taxation system is more in line with other European countries such as France and Germany. In Germany, for example, we know that special rules for taxation of groups were introduced like in the first years of the 19th century. So Italy was not so, how to say, came more in line with this system only very recently. So coming to tax consolidation regimes, as I said, the Italian legislature distinguished between domestic and worldwide tax consolidation. They are both regulated in the income tax code, and more specifically, domestic tax consolidation in articles from 117 to 129 of the IPC, and worldwide tax consolidation articles going from 130 to 142. Starting from domestic tax consolidation regime, as I said before, it's an optional tax regime. We apply the all-in-all-out rule. So this means that we don't apply the all-in-all-out rule. So this means that not all the companies belonging to a group are obliged to opt for this regime. It is sufficient a couple election. So this means that the consolidating and at least one of the consolidated must opt for this regime. But sometimes, especially when the chain of control is very long, we aren't able to meet some requirements which we will see later, and it could happen that we have different consolidations inside the same group of companies. Anyway, we can define it as a regime which allows the consolidating entity, which is the controlling company, to determine the taxable base of the group as the sum of all the taxable income and losses of the consolidated entities, which are the controlled companies. As I said before, we need to meet some requirements, some subjective and objective requirements. Article 117 of the ITC gives us the subjective requirements. We have requirements for the consolidating and the consolidated. The consolidating must be an Italian tax-resident company or another commercial entity. It could also be not Italian tax-resident, but in this case we need to meet two additional requirements, which are the first one: the consolidating must be tax-resident in a state which has entered into a double tax treaty with Italy, and it must carry out business activities in Italy with a permanent establishment. Article 126 also provides for some exceptions, because in some cases the options that this regime is not allowed. In particular, it's not allowed when the consolidating entity, or more generally, when a company opting for this regime is subject to, benefits from a reduced IRES rate. IRES is the corporate income tax in Italy. and it's not allowed to opt for this regime if it's subject to insolvency proceedings, for example, to bankruptcy or compulsory administrative liquidation, a specific insolvency proceeding in Italy for public entities. Coming to the objective requirements, the most important is legal control. As Professor already said before, in Italy we don't have a definition of groups or companies in the civil code, but Article 2359 gives us a definition of control. We have three types of controls: the legal control, the de facto control, and the contractual control. In order to validly adopt this regime, we need a legal control. So this means that the controlling company must hold at least 50% of the controlled company. Better, it must hold a participation which grants at least 50% of the voting rights in the ordinary assembly of the controlled company. So if we have simply a de facto control or a contractual control, the companies cannot opt for this regime. The second of the two requirements is that this control must be exercised from the beginning of the tax period. And the third one is that all the companies opting for the consolidation regime must have the same fiscal year end. Often in Italy, companies have a fiscal year which is the same as the solar year, so it goes from the 1st of January to the 31 of December. As I said before, and as also our French colleague said, the legal control can be exercised directly or indirectly. Sometimes the chain of control is very long. We have, for example, Company A, which controls Company B, which controls Company C, and so on. In this case, we can we can opt for the regime, but we need to check if the controlling company controls indirectly another company using the so-called multiplier method. So, in this case, for example, we have Company A, which holds the 80% of the shares in B, and Company B, which holds the 70% of the shares in C. We have to multiply 80% of 70%. In this case, we have 56%, because 80% of 70% is 56%, so we can still say that Company A controls Company C. So, in this case, companies A, B, and C could opt for the consolidation. As I said, we have two types of consolidation: domestic, which I talked already, and worldwide. In the worldwide consolidation, we apply the Levert rule. So this means that the option is made by the controlling company, the consolidating entity, for all the companies belonging to the group which are not Italian tax resident entities. So in this case, the taxable base of the consolidating entity includes the income of the consolidated. The requirements are exactly the same for the domestic tax consolidation, but we need to meet two more requirements for the consolidating. So this company must be listed on the Italian Stock Exchange, and it must be controlled by natural persons who do not control other companies or commercial entities. The election for domestic consolidation is irrevocable, but it's irrevocable also for worldwide consolidation. There's a difference in time. So for domestic tax consolidation, the choice is irrevocable for 3 years. In worldwide consolidation, it's irrevocable for 5 years. So this would be seen as a disadvantage in some cases. In any case, when the 3-year or 5-year period ends, the companies belonging to the group could renew, could confirm their choice, their option. They can do that expressly. If they do nothing, so if they don't expressly revoke the choice, in that case, the choice will be to be renewed automatically in both cases for other 3 years. Coming to compliance aspects, as I said before, in domestic consolidation, we don't apply the Levert rule, so it's not required for the companies to jointly elect for the tax consolidation regime. it's sufficient that the consolidating and at least one of the consolidated entities opt for the regime. While in worldwide consolidation, we apply the general rule, so the option is made formally only by the consolidating entity, but the option must be exercised for all the companies belonging to the group. In both cases, anyway, the option is exercised by filling an opposite module, which is provided by the tax authorities, which in Italy is the revenue agency. This module is the so-called CNM module. It has to be electronically submitted to the Italian tax authorities. So coming to liability aspects, first of all, the consolidation, the option for the consolidation doesn't exempt the consolidated entity from the duty to submit the tax return to the Italian tax authorities. This means basically that the consolidated has to submit the tax return to, of course, the tax authorities, but also to the consolidating entity, so that the consolidating entity must can determine the tax amount as the sum of all the income and losses of the companies. The consolidating entity is responsible for the payment of a tax amount which is determined on the basis of the global income of the group, so as the sum, as I said, of all the income and losses. The consolidated is, of course, also responsible, but only for the payment of a tax amount which is directly related to the income produced. But if the Italian tax authorities assess a higher tax, in this case, there will be a joint liability of the consolidating and the consolidated for the payment of the higher tax, the interests, and the sanctions. Of course, the main advantage, as we saw with our French colleagues, is the possibility to offset income and losses among the companies belonging to the same group, and these advantages here we compare the ordinary regime with the consolidation regime. So in the ordinary regime, when companies didn't opt for consolidation, tax losses can be carried forward to the next year, but they can be used only by the companies which produce them. While in the consolidation regime, the tax losses a company produced, they can be transferred to another company in the group, and the company which benefits from this transfer will, of course, reduce the taxable basis. This example could be useful to understand what I said. We see company A, company B. Company A in the fiscal year produced an income of 100. Company B didn't produce any income, produced a loss of 30. If the companies opt for the consolidation regime, company B can transfer the loss of 30 to company A. So the taxable base will be 70, and so the tax amount around 17, because the rate in Italy for IRES, for corporate tax income tax is 24%. While if company A and B didn't opt for this regime, of course, company B won't pay anything, but company A will have to pay 24. Just a few words on the VAT. As I said, the Italian legislature introduced two different regimes for VAT. They are both regulated in the Presidential Decree number 633 of 1972. These provisions are very similar to the ones we saw in France. So in this case, we can create, Article 70b of the Presidential Decree allows the companies to create a single taxpayer. The companies belonging to a group can become a single taxpayer to VAT purposes. We need some requirements to be met. So, first of all, we need a financial link, the common control legal control I talked about before. So, the controlling company must have a participation of at least 50%. Then, an economic link. So, the companies must exercise the same core business and economic activities. Or if they don't exercise the same core business and economic activities, they must exercise activities which are complementary, ancillary, and auxiliary. And then the third requirement is an organizational link, so that companies must ensure coordination between their decision-making bodies. In order to create a VAT group, an option must be exercised. So the option is made by submitting a declaration to the Italian tax authority. And as I said before, in this case, we create a single taxpayer with its VAT number. While if the companies prefer not creating a VAT group, they can opt for the VAT group liquidation. This is a special regime. In this case, a new taxpayer doesn't come to existence, but the companies that controlling company can determine the periodic VAT payments as the sum of the VAT positions of each company included in the VAT group liquidation. So in this slide, which is the last one, I just highlighted the key difference between the two regimes. So I just want to highlight the fact that in the VAT group liquidation, the companies maintain their fiscal and juridical autonomy. Thank you.
Okay, so comments and feedback on the second presentation we had so far. We have seen that Italy has actually two regimes of consolidation, one domestic for companies that are resident in the country, the other one is international, so global, but they have different conditions. They have a different impact on the tax liability of the company. So maybe my first question would be, why such a difference? Why Italy just didn't consolidate domestic and international groups in the same way? In your PowerPoint, you said, well, if we want to have a domestic consolidation, you have to be this condition must be met. International, well, it's slightly different in terms of participation, in terms of all in, all out, which is valid on one side but valid on the other. So why it's different? Why such a difference according to residents?
Okay, I can take this slide. So, my view is that in domestic tax consolidation, the Italian legislature doesn't want to reach the level of the integration we talked about before. In the domestic consolidation, it's different from what we see in France. So we don't need such a higher pressure. So the Italian legislature just wanted to, to consolidate but not to integrate. Mm-hmm. So the Italian legislature didn't want to create a single taxpayer. In case of worldwide consolidation, instead, in my view, the integration is higher. So the taxable base of the consolidating entity in worldwide consolidation includes the income of the consolidated. The consolidated entities must be, we apply, as I said, all in all out rule. So maybe the legislator for companies which are not the Italian tax resident wants a higher integration.
Okay. And why do you think that one system there is one all in, all out, and the other one is not? You said in one of the two systems you can do all. You have to do all in, all out. In the other system, not necessarily. You can cherry pick this, yes, the other. In your opinion, your personal opinion, why such a difference? could be normally because on one side, maybe one of the two scenarios, the legislator wants to prevent, tax planning. The legislator wants that the company, the holding company, cannot decide which subsidiary attract the consolidation, because if it would have such a power, he would pick the most favorable, instead of the other. So, in order to prevent too much discretionality.
Oh, okay.
Yeah. One of the answers.
Okay, just to avoid that the consolidating entity chooses the best tax regime, the most favorable regime.
In a way, yes, in a way. Other comments? From behind. From behind the speaker.
I'm just interested how this worldwide consolidation works, because we don't have a worldwide consolidation. So you have your consolidating entity in Italy, and then you can also have consolidated which are resident in other countries.
Exactly. In order to opt for worldwide consolidation, all the entities included in the consolidation must be not Italian tax residents, so they are not in Italy.
Okay, but how do you make sure that you're not transferring losses that are occurred in other countries to Italy to lower your tax burden in Italy, like to prevent tax fraud? Doesn't that go along with that? Or you said that it must be listed in the Italian stock exchange. Are they then taxed in Italy?
They are, yes, because they are taxed in Italy, because the tax of this is included in the income of the consolidated.
Yes. With losses as well. So that's the advantage. We are willing and open also to include losses incurred abroad.
Really?
Yeah.
But doesn't that lead to tax fraud?
Well, not necessarily. I mean, not a fraud. I mean, in a way, it's very generous, so to say. It's very generous on one side. Fraud, of course, possible, likely, maybe, but.
I mean, I totally see the point from the business point of view, because like most companies operate like internationally. Of course, it's just fair for them to use their losses. But I think from German perspective, the legislator would be way too afraid to have tax fraud.
In my view, it's very generous, so to say. From a business point of view, it's quite an advantage, because if you have losses abroad, you can reduce your tax liability in Italy.
Yeah.
So you get a kind of a boost.
Yeah.
Which is not a boost, but it's a way to recognize and to accept losses incurred abroad.
Okay.
But at the very end of the day, I would say it's helpful for the business. Expensive for us, but helpful.
Okay, but you also have regulations to avoid double taxation in the other.
Absolutely. And of course, we didn't go into too much details in this presentation, but indeed, there are options and rules aimed at preventing double losses relief or double taxation and other mismatches that might occur if you adopt such a solution. But there are. Actually, to be honest, I didn't ask Valeria and the other to delve into details, but because international consolidation is not that successful. Only in my experience, only a few company group.
Yes, very few. Also because we waited like many years for a regulation, like not the primary law, but a secondary law to explain how you would have made it with the methods. And I think it was never enacted, like a specific ministerial decree explaining how it should work.
So it's very insecure for the companies.
Yes, indeed, and then didn't have that much success.
Okay.
Also due to uncertainty in its application and implementation.
I have a few questions. So first, I would like to know how in Italy this regime is it consolidato.
Sì, consolidato nazionale, consolidato mondiale.
Okay, and I understood from the presentation for Consolidato Mondiale, it's more integrated than the Consolidato Nacional, correct? So do you in the Nationale, do you only limit yourself to offsetting profit and losses, or also all intra-group transfers are neutralized? The Consolidator Nationale is limited to profit and loss consolidation, or does it encompass as well neutralization of intra-group transfers, such as dividend flows, such as reallocation of assets within the group? For instance, if I have a capital gain on the transfer of an asset from subsidiary A to subsidiary B, is it neutralized within the fiscal unit, or is it taxed?
The capital gain among companies intergroup, they would apply the participation exemption rule, which basically is just a form of exempting the capital gain tax on the transfer from from the subsidiary to the parent company for selling, and this would imply an exemption of 95% of the sale of the shares of the subsidiary, and so the capital gain that would arise on the parent company should be taxed only at 5%. It was. Did I understand well?
Yes.
Okay.
So there is no complete neutralization. It's more participation exemption regime, which is offered to all companies, which with different thresholds, which are lower probably by 50%. I guess. So just to get.
Yes, yes, because also the capital gain tax, the capital gain you could apply only if you have certain requirements, which is also the control, which is the same requirement of the tax consolidation.
So it's 50%. It's not like 10%, like in participation exemption for dividends.
Yes, yes, but for dividends, yes, also you have an exemption on dividend flows from the subsidiary to the parent company.
But that would be on a much lower threshold, I guess, because it's an EU directive.
Yes. Okay.
It's a parent subsidiary.
Yeah, no, but you should have a higher level of control, which should be yes, a higher level of control compared to the one required by the European Parent Subsidiary Directive, which should be 10% the threshold. So usually at European level we have a more favorable regime on controls rather than the Italian one. Yes.
Okay, I have another question, which is, well, in France, just to mention, we used to have like an international tax integration, okay, which was called the regime bénéficiaire consolidé, which was repealed a few years ago. But in France, we do have a territorial corporate tax system. It's not a worldwide corporate tax system. Whereas in Italy,
we have worldwide, for companies as well.
Worldwide corporate tax system. So to answer your question, it does make sense also to have a worldwide consolidation system, but it's limited to listed companies. So, and probably the one which are using this kind of system are the one which are making a lot of losses abroad. And in France, if I make a comparison with France, when we used to have this intégration fiscale internationale, the tax consolidation, régime du bénéfice mondial consolidé, we used to call them the club of costs, because we were like 5 or 6, among which Total, we are doing, we are searching for oil. We had a lot of expenses during several years to find the big oil. and then the profit come much later, and so it did make sense. The other question I had is, unlike France and I guess Germany, and if we call the date for Germany, but in France the regime was in 1998. In Italy, it's quite recent, the regime, 2003. I'm wondering why Italy did wait. I have some ideas why. Probably because of the structure of the Italian economy, or the shareholding structure of the Italian economy.
I know that according to the vast majority of the document in Italy, this changing in the tax regime was determined by the decision of the Italian legislature to modify the Italian civil code, because in 2003 we had a very important amendment to the fifth book of the Italian civil code, which introduced a lot of new rules for companies and also for groups of companies. So this was like undone. It was like a consequence of the decision of the decision of the Italian legislature to intervene on the civil legislation. So after the legislature intervened in the civil legislation, it also intervened from the fiscal point of view to introduce new norms, new rules specific for groups of companies.
And don't you think there was not so much as a pressure from lobby as there were in France or maybe in Germany? Because in Italy you have, like Germany, a lot of family-run businesses, you know,
Yes.
and the shareholding structure of these businesses did not require. It was not as urgent as it was in Germany and in France to have a group consolidation regime, and maybe also just a question, I don't know, but Italy moved to a modern corporate tax system at a later stage, and it was very touchy it's just surprising that it came so late, just 20 years ago.
It could be, I mean, I know that a great part of the Italian economics of the Italian companies are small companies, so maybe applying the consolidation regime, so maybe, as you said, it could be like a pressure from smaller companies, which are the great majority of the Italian companies, to introduce such a regime, specific regimes for companies. Mm-hmm.
Thank you very much. Any
Good afternoon, everyone. I'm Vera, and Katharina and I will now continue with the German system of group taxation. These will be the topics that we will cover. We will begin with the corporate taxation, and we will give you a short overview about the system of corporate taxation in Germany in general, and then we will speak about the system of group taxation, and afterwards we will be speaking about the group taxation value-added tax, and we will give you a short overview of comparison at the end of that. To get started, we will give you, as I mentioned, a short overview about the system of corporate taxation in Germany. A corporation is considered resident in Germany if it has its legal seat or its place of management in Germany. These corporations are taxable on the worldwide income, and non-resident companies are subject to German corporate tax if they derive German source income, which can be, for example, from a German establishment or immovable property located in Germany. The most important companies which are subject to corporate tax are stock companies, partnerships limited by shares, and limited liability companies. The main principle applicable in corporate taxation is the so-called principle of separability. Following this principle, each corporation is taxed as a separate legal entity for tax purposes. The taxation on the level of the corporation must be separated strictly from the from the taxation on the payment of the dividend on the level of the shareholders. Corporations are subject to the corporate tax as well as to a trade tax, which is a local tax applied on trading and business companies. Once a corporation distributes its profits to its shareholders, the taxation on their level depends on whether the shares are held privately or as part of a business. Depending on this, there are different systems applicable to prevent double taxation. However, it is worth mentioning that intercorporate dividends, as well as participation gains procured from both resident and non-resident companies, are almost completely tax exempt. Only 5% of the profit is deemed to be a non-deductible expense. The corporate tax rate in Germany is 15%. The trade tax rates vary since they are set by the municipal governments, but they typically range around 15% as well, and this equals an overall tax burden of around 30% on corporate income. In regard to the legal consequences of the group taxation, which we will explain later, the treatment of hidden distribution of profits, constructive dividends, and hidden contributions, constructive equity contributions, will be important, as the Corporate Income Tax Act prohibits the deduction of hidden distribution of the profits. Instead, hidden distributions to shareholders must increase the corporate income tax base. For completeness, the taxation of corporations must be differed from the taxation of partnerships. Partnerships other than limited partnerships with shares are not taxed as separate entities. The main principle applicable here is the principle of transparency. The profits are calculated on the level of the partnership but get allocated to the partners then. Following this, the partnership is not the subject of tax, but their partners are. So what is the idea behind the group taxation? The rules for group taxation in corporate entities were developed by case law in the early years of the 20th century, so a long while ago, and they were just codified in 1969. The central aim of the taxation as a group in Germany is the possibility of an intra-group loss compensation. Due to the principle of separability, each corporation is deemed its own subject to tax. Therefore, intra-group loss compensations are generally not possible. Another aim is to avoid the double taxation of earning distributions, but we will examine these points more precisely in the following. There are different requirements which the parent company and the subsidiaries must fulfill. In addition to that, the parent company must hold the majority interest in the subsidiaries, and the profit transfer agreement is necessary. So we will speak about these requirements in more detail now. The parent company of group taxation can be a natural person who is subject to unlimited taxation in Germany, a legal entity, or a commercial partnerships with its place of management in Germany. The legal form of the parent company is therefore not critical. Even foreign legal entities can serve as the parent companies, as long as their income is subject to German taxation. Only those subsidiaries which have their place of management in Germany, their location in a member state of the European Union or European Economic Area, and which are subject to the corporate income tax may be part of a group taxation. This includes foreign established corporate entities, provided that they are comparable to German legal entities and meet the requirements mentioned above. For a group taxation to be established, the parent company must own the majority of voting rights in the subsidiaries. This means that 50% of the voting rights is enough. This is determined not by the capital structure, but by the parent company's ability to enforce its decisions. In addition to companies where the parent company has direct involvement, companies in which the parent company is only indirectly involved, such as subsidiaries or companies controlled by them, can also qualify as subsidiaries for group taxation purposes. It is not required that the company through which the parent exerts influence over the subsidiary is part of the group taxation or meets the necessary criteria to do so. As a result, the intermediary company can also be a foreign subsidiary or a partnership. However, the parent company must hold the majority of the voting rights in the intermediary company. And this requirement must be met at the beginning of the tax year of the subsidiary. This group taxation also requires a profit transfer agreement between the parent company and the subsidiary. This civil law contract must be specific for the requirements. The agreement must be in a written form and approved by a majority of 75% of the voting rights at the general meeting of both companies. It must be entered into the commercial register. Additionally, the agreement must be valid for at least 5 years. It may just be terminated because of an important reason. The profit transfer agreement allows businesses some flexibility in choosing which subsidiaries to include in the group taxation, so the German system does allow cherry picking. Through the profit transfer agreement, the subsidiary is obligated to transfer its profits in full to the parent company. However, if the subsidiary incurs a loss, the parent company is required to absorb it, meaning that the subsidiary typically has no taxable income. These are the key requirements for the taxation of the group in corporate tax. The requirements for the formation of the group for the purpose of trade tax are identical and therefore not mentioned twice. Katharina will now continue with the legal consequences.
No, thank you. I'm Katharina and I would like to discuss the legal consequences of German group taxation. First of all, the group taxation does not alter the individual taxation of the entities involved. Despite the profit transfer agreement and the integration of the subsidiary into the parent company, the subsidiary remains a separate legal entity, but the income of the subsidiary is regularly €0. As a result, the taxable profits of the entities must be determined before they are attributed to their parent company. In a group where multiple companies are part of the group taxation, only the parent company is taxed after the losses and profits of the subsidiaries are allocated to it. Where does it lead us? It leads us to the intra-group loss compensation at the level of the parent company, which is an exception to the principle of separability, which Vera mentioned earlier. Secondly, the intra-group profits are subject to tax. For example, this applies to loans or the transfer of assets between these entities. An exception applies to the dividends. If the dividend is distributed by the subsidiary to the parent company, the dividend distribution is not taxed. Lastly, German tax law provides for a compensatory payment. Since only a certain majority of the parent company's voting rights is required to include a subsidiary into the group taxation, there is a risk of disadvantaging German minority shareholders. To address this, the German tax law provides protection for minority shareholders of the subsidiary. These shareholders must receive a lump sum annually, which is taxed as private capital investment. So much for legal consequences of German group taxation. Now we move on to the termination of group taxation. The group taxation ends when the aforementioned requirements are no longer met. This could happen if the profit transfer agreement is terminated by one of the contracting parties. If the profit agreement is terminated before the end of 5 years and there's no important reason, the group taxation's tax recognition will be revoked retroactively. The affected parties will be assessed as though the group taxation never existed, leading to significant tax implications. If the transfer of profits to the parent company is based upon the defective agreement, the transfer of profits is treated as a hidden profit distribution. An offset of losses is then seen as a constructive equity contribution. And now I would like to elaborate on the advantages and disadvantages of the German group taxation. The main advantage is the offsetting of losses incurred by the subsidiary at the parent company, which is an exception to the separability principle. However, the cancellation of the separation principle also has disadvantages, as a parent company may be liable for considerable losses. Moreover, the requirement for a minimum 5-year period of the profit transfer agreement limits the flexibility of group taxation. One advantage of the tax group is the tax exemption of dividends, which we mentioned earlier. Lastly, the German tax law provides for thin capitalization rules, which restrict the deduction of interest expenses, and those rules do not apply to group taxation. And we have now looked at group taxation for the purpose of corporate tax. Now we will move on to the group taxation for the purpose of VAT. The requirements of the taxation of VAT groups differ from those for the taxation of corporate groups, and the formation of a VAT group can take place independently of the formation of a corporate group. In addition to financial integration, organizational and economic integration is required. First of all, the parent company must hold a majority of voting rights to exercise control over its decisions. This requirement is usually met with a shareholding of more than 50%. Secondly, the parent company must control the subsidiary on a day-to-day management level. That a deviating formation of will at the subsidiary is excluded. In practice, this organizational integrated is usually achieved through a complete personal union, where the managing director is identical in both the parent company and the subsidiary. Lastly, the parent company must have a close economic connection with the parent company and the subsidiary. This integration exists when there are significant economic relations between the parent company and the subsidiary. The next topic I would like to focus on are the legal consequences and the termination of the VAT group. Once the requirements of the VAT group taxation are met, the tax group is automatically established. The subsidiary is no longer treated as independent, but is instead integrated into the parent company. The parent company becomes the sole taxpayer for VAT purposes and is responsible for submitting a VAT tax return for the whole group. Services between the companies are not subject to VAT, as they are considered intercompany transactions. Why is it important? This leads us to simplify tax structures and to reduce bureaucracy, as only the parent company is required to submit tax returns. The VAT group taxation is terminated once the requirements are no longer met. We have now covered in this presentation the requirements for the German group taxation. Since the requirements for German group taxation differ depending on the type of tax, we have created a table and we're happy to answer any questions. Thank you.
Now it's your time to ask questions, comments from the floor. So far, Professor Valeria and I have taken the burden or the pleasure to ask a question, actually. But yeah, sure.
I said that in Italy, in order to opt for this regime, for consolidation regime, you have to submit a module to the financial authorities. Is it the same in Germany? I mean, from a compliance aspect, how do you opt for this regime? What the companies have to do?
It depends on the type of tax. When we look at the corporate tax, the parent company or subsidiary have to submit a transfer profit agreement, usually in written form. In this agreement, there's a need for an entry in the commercial register. So there's a formal requirement. When we look at the VAT group, there's no requirement for an agreement. So it's automatically in place when the three links integration is met.
Which is highly risky for companies because it is always questionable, especially because of the inter-group payments they make. If there is VAT included or not, because often it is not, they cannot really tell if there is already an organizational or an economic link. So it is very risky for them if they are already part of the group taxation, which has the result that there is no VAT. Or if they're not, and then there would be VAT. So it is highly risky for them for VAT purposes, but for corporate taxation, as Katharina said, they can opt for it. And also do a cherry picking of the subsidiaries they'd like to include.
And you also mentioned at the very beginning that the consolidating entity in Germany has to have the place of management in the country. Do you normally use the OECD definition of place of management, or has the German tax law a specific understanding of what place of management our company is?
We have also definition of it in our code. What is the definition of
Well, the place where the key decisions for the activity of the company are actually taken, where the CEO and the board of directors take the most relevant decision for the for the business, for the trade, commercial aspect of the companies and such. So it's rather a kind of sort of qualitative condition.
It should be quite the same. For a second.
For instance, in Italy we haven't got such a definition. Place of management, we normally, this is something that academics gives a definition, give a definition to, or the case law is very helpful in providing some assistance. In the black letter law we have nothing. So.
Yeah, like this is the fiscal code.
Yeah.
And it just said that the place of the management is the center of the leading directors or something like that.
Yeah.
So like from where the decisions are made. This is just this one sentence.
Okay, yeah, more or less like that.
But we refer to
we
this.
had previously regime, but now the Italian regulator aligned the definition to the OECD one.
So it's a global standard. My curiosity was that in that sense, in the sense which, according to which different countries align more or less spontaneously when situation comes of specific key understanding, key concept like place of management, place of effective management. Even if the OECD recently has changed the.
I say because Germany is very favorable of all the OECD integrations and everything, as we have a huge problem about tax fraud and everything. We are highly interested in the integration of taxes and everything in Germany. I think many of the virtual and everything Germany is highly interested in that, so I'd say that Germany goes in line with those definitions.
I think in France we have a recent case law where the board of management company incorporated in France, and the board of directors were making decisions in Luxembourg. So they were meeting in Luxembourg. And they claimed that their central management and control was in Luxembourg. And the tax administration said no. And the court upheld the position of the tax administration. They said, well, all the decisions were already taken in Paris, and they just went to Luxembourg to put on paper the decision which was already taken in Paris.
Yeah.
I think the Germans would say that Paris was the place of management.
Yeah, probably it as well.
Yeah. We have a central regulation that states that if you're just making something for tax fraud or to make use of a loophole, then the other thing is
so the substance of the form.
Yeah, next
next
session.
They find a way to get it there.
And maybe the French students would like to ask you questions. Maybe the French students would like to ask you when was enacted the mortgage tax in Germany? Which day? No?
Sorry, what was the question?
What was the question? Quand est-ce qu'on a mis en place ce système? Oui.
When was the system implemented in Germany?
It was firstly implemented in the early 20th century, actually, by case law, and was codified in 1969. It was very early. It was actually before the Second World War already. No, I think for the purpose of VAT, the decision, the size of case law was enacted before the World War II. It was under the former governmental organization. It was also another court that is in place now.
And for corporate tax, it was?
We've just read early 20th century. We don't know exactly what that was, but as World War II
I
was
think
like
it was 1980.
18.
Yes, 1980. So right after the.
But the World War was the World War I was until 1918. So it would be during the war. I don't know. It could be. We didn't see
very
specific date.
because Germany had the first modern corporate tax system in Europe, and the system was when in France we implemented the parent subsidiary regime, which is less ambitious than the tax consolidation, tax integration regime. It was in 1922 in France, the parent subsidiary regime, whereas Germany already had the tax consolidation regime that we implemented in France in 1989, and in Italy in 2003 with much later, 15 years. So much ahead of us, and because of the capitalistic structure of the shareholding businesses in Germany.
Yeah. I've even read that like these requirements that are also set in the directive of the European Union for VAT purposes, group taxation purposes, that they based on this case law of the German, even the Reichsgerichtshof back then from 1933 or something.
Here I have a question, because we as a French, we are proud to say that VAT is a French invention, which was made in the 60s, in 1954, by a French anarch, Maurice Lauré.
Yeah.
So my question is, did Germany add a VAT prior to the Second World War? That's my question, because it was a cascade tax, cascade taxation on turnover, which was not a VAT system with a deduction system. But I was just a bit puzzled when you said that it was implemented, the group taxation was implemented for VAT ahead of corporate tax and in the early 20s.
For corporate tax in the early 20s. Yeah, I've read that about the case law for VAT purposes, but maybe I remember it wrong, and maybe it was implemented for another tax. That can be true, because I don't
talk to the team for VAT, turnover taxes, specific taxes.
I don't know when exactly it was implemented, but I think in the 1980s they changed to this for sure.
So just it would be very interesting that you circulate all the slideshows, the presentation, and maybe integrating the comments we made during the session, and also suppressing into the typo. I didn't mention it, but on the French presentation, it was a fiscal unity. It was written physical unity. So it's a typo, so you can do a spell check, with the word or PowerPoint. And so I know that Marco would like to upload the presentation.
Yeah, possible. I didn't create a website, official website yet, but I will do that with the video, the pictures we take from time to time, and encourage you to take pictures, and the best one to be published, and that's also PowerPoint.
So maybe now we have the time for conclusion of this session, if I understand. So we can thank you very much.
So hello, my name is Pauline. To conclude this presentation on the tax consolidation regime in Italy, Germany and France, we have chosen to offer you a comparative study. The tax consolidation regime in France, Germany and Italy are based on similar principles, but with notable differences in terms of eligibility conditions, operation, and tax consequences. We will proceed with a structured comparison of the similarities and the differences between these three countries. Regarding the common points linking these three regimes, so these regimes allow a tax consolidation within a group of companies in order to optimize corporate tax management and offset losses and profits between member entities. The parent company of each consolidated group identifies the taxable base of the group and is liable for the tax determined on this taxable base. As a result, only one company is liable for the payment of the consolidated tax in all those countries. Concerning the parent company, France, Italy, and Germany require that the parent company must be a legal entity whose place of management is located in the respective country, except in Italy with the consolidation for international companies. So any company located in another territory cannot be considered as the parent company of the group. In all cases, tax consolidation in Italy, Germany, and France remains optional. Companies wishing to form a tax consolidation group must exercise their option with the competent tax authority to which they are subject. We can also specify that the legal basis for those regimes originates from legislative texts. So in France, there are the articles 2023A to 2023U of the French General Tax Code, CGI. In Germany, it is the Article 14 of the German KSTG. And finally, for Italia, it's the Article 117 to 129 of the Italian TUIR. The main difference of those regimes is that Germany and Italy only require a majority stake of the parent entity in its subsidiaries with more than 50% of the capital or voting rights. In contrast, France is more stringent and requires that the parent entity holds at least 95% of the shareholdings in its subsidiaries. France is therefore particularly strict, and many French companies cannot be considered parent companies and be part of the system. Additionally, unlike France, Germany provides for a tax consolidation group not only for corporate tax, but also for all other taxes and duties owed by the companies, including VAT and business tax. In Italy, companies can also form a VAT group. In these cases, there is only one single taxpayer. In contrast, France also allows for a VAT group. However, this option is not subject to the condition that the companies belong to the same tax consolidation group. Nevertheless, the three VAT groups regimes share the same conditions, so financial links, meaning holding more than 50% of the capital, economic links, and organizational links, meaning common management or the organization of these activities either wholly or partially in coordination between the companies. In order to prevent opportunistic tax optimization strategies, a required duration of group membership is generally imposed. France sets a duration of 5 years, and Italy requires the group to be maintained for 3 years, while Germany does not have any legal duration condition. Like France, Italy also provides for a 5 years duration in worldwide consolidation. As for France and Italy, both countries stipulate that the option is automatically renewed after the expiration of the legal period. The aim of these regimes is the consolidation of the group's results. However, the three countries do not provide for the same type of consolidation. So France implements full tax consolidation. That means the tax will be calculated based on the sum of the results of the companies. In contrast, Germany provides for economic and tax consolidation with the goal of offsetting the profits and losses of each of the group's member companies. And finally, Italy establishes tax consolidation with an option to neutralize intercompany transactions. Regarding the impact of this regime on tax deficits, the treatments differ depending on the country in question. France provides that the losses of a subsidiary can be offset against the group's results, thus reducing the group's taxable income. Germany, on the other hand, allows only future losses of the subsidiaries to be offset. Finally, the Italian tax consolidation system allows the offsetting of companies' losses against the group's profits. Regarding VAT, France does not require that tax consolidation be supported by the VAT group regime, unlike Italy and Germany. As a result, intra-company transaction will be subject to VAT by default, unless the groups opt for the VAT group regime. In contrast, intra-company transaction will be exempt from VAT and corporate tax for Italian and German groups. Finally, concerning the tax liability of the companies within the group, France provides for joint liability for all the companies regarding the payment of corporate tax. In Germany, the parent company and the companies are responsible for the payment of the corporate tax. As for Italy, joint and several liability is recognized for all the companies. We could conclude this presentation by highlighting the intrinsic force of the different regimes. So Germany was the first one of the three countries to introduce the tax consolidation regime in 1969. Subsequently, tax consolidation came into force on the 1st of January 1988 in France. Finally, the most recent tax consolidation regime is the one existing in Italy, as it was created in 2003. At first glance, these differences in the dates of implementation of these regimes might suggest that the tax consolidation regimes in those countries studied will be very different. However, as we have seen, only a few slight differences exist. This coordination of the tax consolidation regimes could be explained by the fact that Italy, Germany, and France are all members of the European Union. Although there is no European directive today specifically on tax consolidation, it is worth noting the existence of the parent subsidiary directive. This directive does not directly concern the group's results, but focuses more on the taxation of profits distributed by subsidiaries to their parent company. It aims to exempt them from withholding tax, which leads to the elimination of double taxation in the case of profit distribution. To benefit from this advantage, the companies involved must be subject to corporate tax in a member state of the European Union where they are established. Additionally, the status of parent company is recognized for a company from a member state of the European Union that holds at least 10% of the capital of a company established in another member state.